What is up everyone, and welcome back to another video. Today we are covering two crucial aspects of trading, which are going to be mitigation blocks and breaker blocks. Now if you've heard of these or not, it does not matter because we're going to cover everything from the basics to the advanced on these blocks. Now let's jump straight in. And what actually are mitigation blocks? Well, in simple terms, a mitigation block is an area on the chart where the market retraces to balance out an impulsive price move. Whenever there's a big sharp price move in one direction, let's say a strong push up or down, it creates an imbalance in price, often leaving what we call inefficiencies in the market. Now these areas are where the market comes back to clean up or fill that imbalance, and that will be usual mitigation block. So let's use this as an example. Here we have what would look like a bullish mitigation block and a bearish mitigation block. So let's start off with the bullish. Now usually on a bullish mitigation block, what we will see is some sort of downward move followed by a low created, then we will see a little price move up created by a high, and then we will create a higher low right here. Now this area right here will be our mitigation block, and after this move up, when we create a higher high, you will usually see price come back down to this area, fill it either 50% of the way, tap in just above, or 100% of the way, and the move will carry on up. This is usually what a mitigation block will look like. Now a bearish mitigation block, on the other hand, is the complete opposite. We will usually have a move up that creates a high, then a slight move down which creates a low, and finally a lower high right here. And then this will be our mitigation block. Once the price breaks through the previous low, we'll usually see it retrace back up, again tap in just below, fill 50% or 100% of the block, and continue the move down. Now here's how we would usually plan out a trade for a bullish mitigation block. So again, after step 1 is created, we create the low, then step 2 we create the high, and step 3 we create the higher low. This will be our mitigation block. Now you want to draw on the mitigation block after the high is cleared, like here. And usually when we place our trade, again this will depend on your strategy, but a high confidence trading strategy on a mitigation block can involve a fair value gap somewhere in this order block. Now this will also usually be a range of 2 or 3 candles, so we can find an fair value gap somewhere in here. And if you do, then you could place your entry off the 50% of the fair value gap fill or 100%, as we talked about in the previous fair value gap video. But let's just say here, for example, we don't see a fair value gap and it's just a simple block. So we can place our entry at 50% or again, just the tap. It will depend on your strategy and how much you want to risk. And then we will place our stop loss usually either at the bottom of the mitigation block or at the low. Now again, if you want to risk slightly more, you can place it at the low. If you want to risk slightly less, you can place it at the low of the mitigation block. Now one key thing to remember is if you place it at the low of the mitigation block, the chances are much more high that your stop loss will get hit, as the mitigation block can get filled 100% of the way and your stop loss will then be hit. So just for argument's sake, let's say we place it at the low and we have our entry point at the high. Now this will be your most probable entry, meaning that your entry will get hit most of the time and your stop loss won't get hit most of the time. But that also makes your risk to reward much worse. As you can see here, if we place our take profit at the previous high, just in this example, your risk to reward is 0.9, which is not that good. However, if we place our entry point at around 50%, you can see your risk to reward is instantly nearly 2. So it all depends on your strategy and how much you've back tested and whether that win rate and risk to reward will make you profitable in the long term. Now, usually you want to place your take profit either at the previous high, or if there's some sort of supply area or other order blocks, etc., or fair value gaps higher, you can place it there as well. Then after that is complete and we've placed our trade with our take profit and stop loss, we will wait for price to retract to our entry and then go to our take profit or hit our stop loss. Now one key thing to remember again is, as I've said in multiple videos, is that it's not a 100% win rate strategy. That means that your stop loss will also get hit a bit of the time, but what matters the most is that your risk to reward ratio is planned out effectively so that when your stop loss is hit, you can hit your stop loss 5 times in a row, but that one trade that you win does outweigh all of the losses in profit. Now here is an example of a bearish mitigation trade. So again, we see a large move up, usually from an uptrend, and we create our final high right here. Then we'll see a downward move. Usually this will be some sort of change of character. Then we'll see a higher high created. Again, these are all marked out 1, 2, and 3 in the exact sequence that they should follow in. And once we create that lower high, this will be our mitigation block. Now you only want to draw on your mitigation block in the bearish scenario once we clear this low right here. Then once it's cleared, we will usually place our trade again either at the bottom of the mitigation block, at the middle, or at the top. Now whichever way you place it, it will always change your risk to reward. So once we place our entry, let's say here again we place it at the 50% as I usually do, we will place our stop loss at either the high 100% of the fill of the mitigation block. I usually like to place it at the high, as we can always fill the mitigation block and then our stop loss will get hit and the move will carry on. But if we place it at the high, or in the bullish scenario at the low, the only way this gets cleared is if we sweep above the highs or the move carries on and we continue the uptrend, in which case our analysis was just wrong or the market didn't want to follow our trade. Then once that is done, we will usually place our take profit at the previous low or at any other demand zone or fair value gap or order block that you see on the chart. Here we will just place it at the low because that's all we have to go off. Then we wait for the trade to come up to our entry. We might go into slight drawdown and then the trade should continue and we hit our take profit or we'll hit the stop loss. Now there are two key tips for trading with mitigation blocks. The first one is, as I've said before, make sure you analyze your risk to reward ratio and win rate by backtesting. Whether you're just implementing your mitigation block strategies now or you're already using them, you have to make sure to backtest the strategy, see the win rate, see the risk to reward average that plays out, and make sure it's actually profitable in the long term. So many times people go into trading and they want to have a high win rate strategy with super high risk to reward, but they only will get one trade a year, or in other times they have a super low win rate strategy with a super low risk to reward and they will get 100 trades a day, but in the long term of after a few trades they'll have blown their entire portfolio. So make sure to analyze and find the sweet spot. Now the second tip is to always use confluences such as change of characters, break of structures, or even fair value gaps to help with the mitigation blocks. Don't just enter because you see a mitigation block and want to hit the trade. You always want to try and find some sort of change of character, break of structure, fair value gap, other order block that will help with your entry point, stop loss, and take profit. That way you always have more than one reason to enter the trade and it will usually result in a higher win rate and better risk to reward ratio. Now we move on to breaker blocks. So what exactly are breaker blocks? Well, these are a little different from mitigation blocks, but they're just as important in your trading strategy. A breaker block will usually occur when the market tries to push in one direction, like breaking through a support or resistance, but fails and reverses. This failed area then becomes the breaker block. So here is an example of a bullish breaker block. We'll usually see a high created followed by a lower high and a lower low. Now this area right here will be our breaker block. You can see the price tried to push below, instead it didn't carry on the move down. We saw a higher high created and this now turns into our bullish breaker block. Now for a bearish breaker block, it's actually the complete opposite. We see we're in an uptrend, we create a higher high, a higher low, and another higher high. We try to continue the move up by creating a higher high, however the higher low didn't complete and we created a lower low right here. This then becomes our bearish breaker block. Now this sequence is always what creates a bearish or bullish breaker block, and that is how we spot them. Now we move on to how we actually find a trade with them. Now here is how we would want to trade on a bullish breaker block. So again, we're in the downtrend. The first thing we do is create a low. The second thing we do is create a lower high right here. And the third thing is we break the structure. So everything follows as a normal downtrend would. However, we've now completed this sequence and we get a higher high right here. So after we get that higher high, we can start to draw on our breaker block. Our breaker block is usually from the low that we created to the lower high that we created right here, and we ignore the break of structure. Then we will usually place our entry either at the top, bottom, or the middle of the breaker block. Again, I usually like to use my entry at the middle of the breaker block, just as the perfect balance of the 100% fill or just the tap. If you want to get the most trades, then you will want to be placing your entry at the top of the breaker block. And if you want to get the best risk reward ratio, then you want to be placing your entry at the bottom of the breaker block. So once we've placed our entry, we need to actually place our stop loss. Our stop loss, at least mine, will usually go at the low that we created here on the break of structure. Most people will also place their stop loss at the low of the breaker block right here. However, this can usually result in your stop loss being hit a lot of the time, as on a breaker block or any sort of order block, we can always fill the 100% of the order block and then continue to move up. So in my case, I like to place it at the low, and then my take profit usually at the previous high or any other fair value gap, order block, or anything like that we have above. Once we've done that, the security will usually come back down, fill our entry, either hit the stop loss and continue to move down, or go to the take profit in most cases, like this. Now again, a key thing to remember is that it's not a 100% win rate strategy, and that your stop loss will also be getting hit a bit of the time. But if you have a positive risk to reward ratio and a good win rate, then your strategy will be profitable in the long term. Now we move on to a bearish breaker block trade example. So again, similarly, we will firstly create a high, then we'll create a low. Again, this is just a normal uptrend, and then finally we create a break of structure, clearing this high. Then after that, we will see a large move down, usually creating a change of character from the low, and we draw on our breaker block from the high to the low, ignoring the break of structure, similarly to the bullish breaker block. Now to find our entry, we can again use the low, the middle, or the high of the breaker block. I like to use the middle, and then we place our stop loss usually at the high of the breaker block or the high of the actual security. After that, the take profit usually goes towards the low or any sort of fair value gap, order block, or demand area that we have below, and that will be our trade. Then price can usually come back to the fill out entry 100% the tap or 50% of the way, and we'll come back down to hit our take profit. And this is usually how a bearish breaker block will play out in a trade scenario. Now what we can also do in a bullish or bearish breaker block scenario is find a fair value gap somewhere in this range of candles right here. So say for example we have our fair value gap right here, we can find our entry much easier, and this is a much more higher probability bearish breaker up, and then this becomes a much higher probability breaker block. So if you watched our fair value gap video, you'll know that I like to enter, of course, at the 50% of the fair value gap fill. So say we find our fair value gap right here, I will enter at 50% and then place the take profit at the high, stop loss at the low, and this then becomes our trade model. Now the reason this is a higher probability model is because we're using much more confluence. Rather than just using a breaker block on its own, we're now using fair value gaps and breaker blocks to find our entry. And although less of these might occur during your trades, these will usually result in a much higher win rate and much better risk to reward. So if you want a trading strategy that involves less trades but higher win rate and higher risk to reward, then I'd suggest using this sort of trading model. Again, this works the exact same for bearish breaker blocks, but we just flip it upside down. Now, if you've been paying attention, you'll probably already see the difference between mitigation blocks and breaker blocks. But if you don't, then here is what it is. So mitigation blocks will usually occur after a strong price move up or down, and they will represent areas where the market will retrace to balance the move out. Whereas breaker blocks occur when the price tries to break through that key area but fails and reverses, usually signaling a potential trend reversal. So with mitigation blocks, we'll usually create a low or a high, and then the second low or high doesn't come anywhere close to equaling out that other lower high. Whereas a breaker block, once we create a lower high, the next move will usually break that lower high, allowing us to find our breaker block somewhere there. So in essence, mitigation blocks are about a continuation of a trend, while breaker blocks are usually signals of a possible reversal, which is why it's key to use fair value gaps, change of characters, and also break of structures. Now, if you did enjoy the video, make sure to like and subscribe, as it will help out a lot. If you want to get more trading strategies, then check out the Discord down below, because we have a lot of learning resources, a lot of courses, and we also have live calls to help you learn trading. If you need a place to trade also, check out the links down below. Thank you all for watching, and I will see you all next week. Goodbye, guys.